Good afternoon, folks. This is Kim Camarda. I'm sitting in for Troy this week on This Week in Wealth. We're going to do something a little bit different this week rather than recap the previous week's action. We'll take a look at the China situation from yesterday. I've got a chart up on the screen and we'll look at the market action and then get into some of what our indicators are telling us. So before I get into that, I do just want to ask you to take a quick moment to like and subscribe to our channel, because depending upon how you're seeing this, you may or may not get notification in email, but if you do subscribe to the channel, you'll get notifications every time we post new content. All right, so yesterday, as you all know by now, it was due largely in part to Evergrande, which is the world's most indebted property developer based in China. And it's really the scares that they're going to default on billions of dollars in debt that sent waves of fear and shock through the markets yesterday. One of the interesting things, which I have up on the chart, and I'll see if I can zoom in a little bit, was selling off hard at one point in the day, but one good thing to note is it didn't sell off hard into the close. It rallied almost a good percent there toward the end of the day to close it better, and of course we bounced up just a bit today. In zooming out here on the chart, for the better part of the year, we've been traveling in this intermediate term channel with the market, eking out these higher highs. And every time, just like yesterday, we had some buyers step in, and that's what's kind of been happening here all year. As we pull back just a little bit, the buyers kept stepping in all along the way. We had that big pullback in March, buyers stepping in. So that while we've closed down below that 50-day moving average and we're outside of this channel, still seeing the characteristics of the way the market was behaving, in that there's buyers here at these support levels. So this hopefully should just be a little short-term shakeout from some of the Evergrande. And we'll see as the markets start to open again. They've been closed a couple days for the holidays, how Beijing is going to react to possibly bailing Evergrande out. In terms of it being, I know they'll throw things around like, oh, it's the next Lehman Brothers. In terms of it being a financial crisis, I'd think of a financial crisis in terms of more safer assets doing something unexpected, right? That's what causes that shock and that crisis. Evergrande is not quite that case. I mean, there's been stories back since 2015. They got a $16 billion bailout. I just saw a news article this morning. The New York Times in 2017 said that they are the biggest Ponzi scheme they've ever seen, just with the continued lending after lending to this company. And all along, to be fair, their debt has always been not just junk debt, but one of the lowest rated junk debts. So the risks with Evergrande, not unforeseen and not really the kind of thing that's necessarily a financial crisis. I mean, their debt was junk, and that's sort of always been priced in. I mean, a risk that you could see happening, and hopefully more or less contained just to China. I was reading this morning that U.S. exposure with our major banks, as far as Goldman, JP, BlackRock, that have pieces, they don't have quite that much money exposed. So exposure here in the U.S., not that big with our major institutions. So certainly something that's going to affect China longer term with their GDP and their real estate markets. Most of their banks very heavily involved. So it will be interesting to see, maybe even from a face-saving maneuver, what Beijing does to step in and stem that tide. Certainly something that's adding a little extra spice here in the short term to the volatility mix. But again, not something unexpected. We really haven't had a big pullback, and momentum really has certainly been waning over the last couple of months. You can see there's like a little, I've got the dotted line, which shows sort of the mid-range of this channel we've been traveling in. And the market, unlike earlier in the year where you can see us hitting the tops of that channel, hasn't really been able to do that. We've been slowly grinding higher, but the momentum really hasn't been there. So all it takes is one news event really to make it roll over. So that's sort of where we're at from a price perspective. This little gap from yesterday is going to cause some short-term resistance. We're trying to get up there today, so we'll see if that's going to keep the market a little bit hampered here in the short term. Also to note, we're going into a 2-week period, which is historically pretty volatile. We're closing out the third quarter. There ends up being a lot of the window dressing by the portfolio managers, so a lot of selling and changing up anyway, which usually makes this next couple weeks more volatile than usual. And then, of course, we've got the Fed coming on with their more tapering talks, which will probably start November, December. So, of course, they're getting ready to meet here later in the week. But that's where we are from a market perspective. We'll see how China ends up playing out and what do our indicators say about it. Since we're more based on the what is, we've got our indicators. Our top one here, the longer-term bull-bear indicator for the U.S. equities. Still, obviously, in bullish territory. The number's been trending down somewhat. Our quarterly indicator, still positive. Our shorter-term indicator, one that fluctuates quite a bit whenever we get any of these volatilities. So any of those downdrafts that you saw in my previous chart usually tend to make this flip negative. And all that really is for us is just sort of like a caution flag on the racetrack, right? Just says, hey, pay attention. Because you never really know when does it start? When does it just become a short pullback and a bounce, or when does that start to slide further? So really just a caution flag that went up on Friday. One of our indicators, the balance indicator, we call it the BOSS, that one spans 3 different time frames, right? Short, intermediate, longer term, and then also tracks the movement of funds out of equity-based investments into cash. So that is still positive. One thing that is interesting, I'm going to slide down here further. Here's cash. Right here, I guess in the top third of this below average, this really has moved up quite a bit. It's been hanging out down here at the bottom, but recently in the last week and a half, really has moved up. So that's something, while this ranking of the various sectors and style boxes, that movement of cash isn't directly in that BOSS indicator. We've got a slightly different way that it gets tracked. Interesting to see that, though. So we have our eye on that. A lot of the other major asset classes and sectors still pretty much where we've been allocated, no big change there. So that's what we've got our eye on and where everything's been this week. If anything changes, we'll come out with another video, but until next time, I just want to thank you for watching. Remind you to go ahead and subscribe to that channel. But if anything happens, we'll be out with another video for you later this week. Thanks so much for watching.